Tim, good morning. How we doing?
Good morning. Well, that's one of my favorite sounds, Market Structure Monday.
Where it feels like whenever we talk to you, you've got a new background. Where are you this time?
This guy's everywhere, man. He has so many houses, we can't keep track of them anymore.
Well, this is not my house.
Oh.
It reminds me, however, of a great musician because I just came from Nashville down here to Austin, and there's this guy named Alan Stone, and he did an album called "Live from His Mother's Living Room." So I'm actually coming to you live from my mother-in-law's back deck here in Austin. It's in Georgetown, Texas, actually. But you can see spring has arrived here in Austin.
That is beautiful.
Everything's awash in verdant hues.
Wow, that is beautiful.
Yeah.
My trees have no leaves, unfortunately, in Georgian Bay. No leaves up here, but it looks beautiful down there. I'm jealous.
Well, and to finish your beat the clock theme, you don't remember that, do you, Tim? I do not. So Joel, apologies that I do not recall that, but a great version of it happened in the Gonzaga game. Talking about beating the clock.
Oh
my goodness,
that was unbelievable.
That was fantastic. Where's James Mann, the guy that was? Someone in the chat, they asked for symbols, Dennis. They asked on Friday or Thursday. They asked for UCLA.
Of course they did.
Is that mean? And I railed that guy. Mean. We kicked him out of the chat.
Out of the chat for that.
We kicked him off the YouTube. We canceled his Benzinga Pro. Yep.
Well, there have to be consequences for stuff like that. No question.
That's tough, Joel.
Tim, what's on your radar here this morning?
Well, there are two things to me. In addition to Palantir, which I'm surprised Dennis hasn't taken me to task about. But the two things to me are because the audience here tends to favor EV, electric vehicles. And it's been tough in that group, hasn't it?
Yes.
and when should it not be tough in that group? And it leads into the second thing, which is now we're in the early, I think in market structure terms. And broad market sentiment, the way that we measure it, bottomed March 31st. And of course, April 1st was a good day. Don't be fooled, however. And so how do those things dovetail? I'm not sure how interesting that is. It's always interesting to me, but I thought it would be worth talking about that. We continue to have this great debate about, whether value stocks are now permanently in the lead. They're not going to be. They're not going to be. If 50% of the market cap sprinkled across tech, communication services, consumer discretionary is tech is going to resume leadership. Interestingly, if you look at the FANGs, to me, they're a bit behind. All over the market, the sentiment trends have turned. And, I like to think of these cycles as taking about 10 days. Well, what lies 10 days hence? April options expirations. I think that traders today just have to think in those terms, and it's very easy to get caught up in all the rhetoric that surrounds us about stimulus checks and government programs, and on it goes, and that these things will create a permanent bull market. I don't believe it. I think you have to come back to the things that are fundamental to the market, not fundamental in terms of financial performance for companies, but how the market works today. And to me, that is what matters. I'll give you a case in point if you want. You can lead me wherever you want to go. My inclination is to just let's go look at Churchill Capital, Lucid Motors, and
that'd be a good one to look at.
CCIV.
Yeah, it's been a while since we talked it. Let's talk CCIV.
Yeah, I think it's worth doing. Particularly since if there's some news that maybe the retail sector of the market is a bit in the doldrums. By the way, if you're listening, you can come do this. Just go to marketstructureedge.com. You can sign up for free. There's no credit card required, and you can see the same stuff that I'm seeing here. So I have, of course, Benzinga April 5th on my screen, but I put Lucid in here because I think it's interesting to look at. It's a 1 out of 10. And the way that I think of the market is everything waxes and wanes from overlove to underlove, to use Nick Shaheen's description for it. Think when there is more demand, then things trade above 5. And when demand wanes, things trade below 5. And it's very consistently true. So if you look at Lucid Motors, Churchill Capital here, it's a 1 out of 10. Short volume below 45%, very attractive. This is the challenge with Churchill. It only trades $3,000 at a time. So it's tough to get in and out of. It's interesting that active money is back in it. It's in the consumer discretionary category. And sentiment is bottom. So I look at this purely from a market structure standpoint and say, wow, this is very interesting now. If you want to make money in something, you leave when sentiment is taut and begins to slide, get out there, and then you return when sentiment rises above, begins to tick up and rises back toward 10. The trouble in here is options expired here. And this is where all over the market, this Archegos Capital thing occurred. And you could see it right around the 19th that the banks all bet short. And why this matters, if the banks lose, we're in trouble. The banks lost in 2008. Here versus Archegos Capital, they've got 6 prime brokers. And I'm talking about the headlines last week, folks, where this hedge fund had a disaster and its positions in Disney and Viacom had to be sold. We can take a look at those. But this, to me, presents opportunity. Early in the month, money looks around for, well, what do we want to do? Sentiment is bottom, short volume's right at trend. These things, that to me is what matters. It's not whether Lucid is delivering on its promises in the short term. It's whether it's attractive from a market structure standpoint. Yeah.
I mean, I kind of don't mind the technicals on this one either. I mean, you have a level now. 2040 was the low back. Me and Joel like the levels where we just look at the chart. And you know, 2040 back to March the 5th. You challenged that, recently, and we've held those levels. So we did not make a new low on the move, which is good news. When you don't make a new low on the move, you're telling me sentiment is bottom. So everybody's kind of, seems to be as bearish as they want to be on this thing. It doesn't mean it can't get worse, but yeah, at least have an out. I think, if you're buying it here, you stop yourself out below 20 and you say, hey, maybe it's just a turnaround. Maybe you could have a little, a little turnaround in the stock price. So.
Somebody that I think everybody forgets about that is in this group, and no one ever talks about it, and yet it really delivers returns, is Eaton. Eaton is it's loosely in this EV group, I'll grant you, but talk about a great stock to trade. When it's above 5, see this is a scale. It's a 10, just banging against the ceiling, ticks down. That's where you leave. And when it ticks back over 5, which it just did, that tends to be a great time to own it. It consistently produces good returns when it rises above 5, and nobody talks about it. It's actually an excellent company. It's very strong. It's got great liquidity, $11,000 per trade. Short volume's very low. The trend is up. Even though it's a 6 now, remember, you get your returns above 5. That's something I think people aren't thinking about. So I would point, we're talking about EV. Sometimes you go where people aren't, and you get your better returns there.
That's been working too, and 2.18% dividend, reasonable price earnings ratio here. So it's a little bit falls more into the value camp, which is obviously stocks where the market has gravitated to over the last month and a half. Even sitting up near the highs. Chart doesn't look bad. I love buying stocks near the highs because new highs beget newer highs. So if this thing can break out over that 142, I think you're giving us some good ideas here this morning, Tim.
Could be, and I'll give you another. Since Disney has been in the news, clearly not an EV play, but I wanted to show you how this destructive bet for Archegos played out. So on my screen, if you've never seen these weird charts before, folks, this is short volume. Short volume is the percentage of trading volume coming from borrowed stock. It is the supply chain in the market. But when it jumps above trend, here's what happened to Disney. Short volume shot up to 50% right at options expirations. That will always tell you that the counterparties for the bets have bet short. They knew that this bet was blowing up. They knew a week before it hit the news because they're looking at their books. They're probably talking to these folks and saying, look, if you don't shore up your capital, we're selling your positions. And there it was. But look at it now. It has completely reversed. All those bets are out. Short volume is below trend. Sentiment in Disney is ticking up. That is a nice trade, believe it or not. It's, this isn't probably the pre-market prep's favorite kind of stock, but that looks pretty good. That's, if you think in terms of market structure, that looks appealing, and the risk has come out.
If you're thinking the full reopening, I mean, where's everybody bringing their kids? They're going to Disney World. If we get this thing vaccinated, we get past COVID. The wild card is this Brazil variation here. Obviously, we've got problems with it over in British Columbia and Canada. Vancouver Canucks, a couple of them having, the whole team sick. I mean, that's a little bit of the scary part of it. But if you're full on that we're going to get past COVID and we're going reopening, Disney is a place to be. Right.
Now, that opens the door to a very brief, because we'll put everybody to sleep if we start talking monetary policy and economics. It continues to.
What's that?
I may just narcoleptically drop off talking about this, but something I always like to point out. I realize I am not in the majority camp that says all we have to do is throw money at things and everything will be awesome. History, thousands of years of history, all the way back to ancient Egypt, teach us that rising debt and rising prices are the enemies of prosperity, not its authors. And yet we're being told that somehow that's going, the presence of massive amounts of debt and rising prices are rising. It's crazy, right? So driving all over the country from Denver out to Nashville, and then Nashville down to here to Austin, gas prices are up just this year 87% across the country. Well, that won't hit me, but it will hit the construction workers with the giant trucks who get 12 miles to the gallon. It's hitting them. That's a big increase in cost. And I don't believe that those things are going to long-term solve our problems. I think you have to have efficient production and strong purchasing power. Those things produce strong economic outcomes. Now, for us traders, the good news is we don't have to depend on that. The market, in a way, functions on its own in terms of supply and demand and the flow of money, and you can take advantage of that. But you have to be aware, I think, that we are on the same path that Japan went on in the late 1980s, and that ended up stalling that market. And at some point, we're going to run into that buzzsaw. We'll see it coming, and we can trade our way around it. But I think it's important to contemplate that fact.
Tim, you mentioned Palantir quickly. I bring them up only because the stock is up $1 this morning, and they did some really small contract that is probably not even that notable. But as I said, the stock is up $1, so here we are. Give us an update on Palantir.
Yeah, let's have a look at it. And look, it's taken longer than I expected. Dennis, you and I talked about this, I own Palantir because it's one and it's a bottomed and it's 37% short. It's not my favorite from the standpoint. It's not a very liquid stock. Why this matters, folks? Why do I track dollars per trade? Dollars per trade is the amount of stock you can buy before the price changes. And if you're running billions of dollars, big institutional investors, their algorithms have to get into that vein. They have to know that if I buy more than this amount, my price is going to move. And they're very concerned about transaction cost analysis. How much price movement can I handle before it destroys my returns? And you add in commissions, the tax consequences. You have to think that way. So if you're buying this, buy less than that at a time. What's very interesting to me about Palantir, and I'm going to back this up, is how difficult it has been for this stock to recover. And I think it relates directly back to that. At $4,300 a trade, it is outside the top 1,000 most liquid stocks in the market. And the Russell 1000, they're a little bit different because one is measuring liquidity, one is measuring market cap. But 95% of market cap is in the 1,000 largest stocks. That's where the money goes. That's the stuff in the ETF baskets. It's the stuff that the indexes will sample. Everybody does that. Well, Palantir's been just outside of that. And so it's had a harder time. But once again here, short volume well below 40%, just about at trend. Sentiment, I got in a little early, but you buy the uptick and you're probably going to make money on this. At some point, money is coming back to this. And I think between now and options expirations is a very good time and a very good probability, because people can make money in the options as well if that stock starts to rise.
It's a widely owned stock by the retail crowd, and
right.
Obviously, if we get back into this growth market, it's probably one that's going to rebound quickly. So,
yep.
It's just a matter of there's a lot of overhead supply. There's a lot of traders who are stuck in this thing, and they're down money in it. And I think if we get up over 25, that's where it starts to get interesting. But below 25, yep. I think bears are still in control here.
Yep. And if you do, traders, look, here's where things were awesome, right? Above 5, that line above 5, awesome. When it begins to tick down, even though you might miss a little of this, you want to be out before you give back your gains, right? That doesn't do you any good to buy a stock that goes way up if you miss out on when you should leave. You just got to be happy with that. If sentiment tells you, oh, we're starting to equalize, well, get out. It'll be a little ahead of the change, but look what it will save you from. And then you can come back when it's above 5.
Yeah, what's your average hold time? Obviously you're always tracking
right.
sentiment, and
yep.
This can change quickly. Sometimes it takes a while to change, but it can change quickly as well. When
right.
you're jumping in, on a sentiment trade,
yep.
We say sentiment really low. Do you know what the average hold time is on some of your trades here?
5 days.
5 days. So
5
there you
days.
Go. So that's a pure swing trading environment. 5 days. So
yep.
it's a nice spot too. Like we talk long-term investing a lot. We talk short-term
right.
trading. I mean, the 5-7 days, that's a sweet spot, because it's a tougher, like I've always said with high frequency trading, they're trading in milliseconds.
Right.
And if you're trying to trade, in seconds or milliseconds, and you're trying to scalp the spread, you're not going to beat Citadel and Virtue in that game. But in this
exactly.
5 day, 7 day, that's not Virtue's and Citadel's bread and
right.
butter. 5-7 days.
They don't want to hold something out.
They're not, that's not their bread and butter. So you're not going directly against the big high frequency trading firms in that time frame. So it's kind of the sweet spot. And that's why we have a lot of very successful swing traders in our chat, because the competition from the professionals is not as high. I'm not really in that 5-7 day time horizon either. I'm more in the minutes to hours, looking at micro inefficiencies, not in the milliseconds, because I don't want to compete with Citadel and Virtue. And I'm not Warren Buffett long-term investing, but I think you're in a sweet spot there, Tim, at 5 to 7 days. I love that time frame.
Well, and it shows up in the patterns. I didn't arrive there accidentally. When we were examining this data a decade ago, right after the Reg NMS changes, right, that changed everything. And look, I prefer a long-term market. I wish that we were about long-term capital formation from an economic standpoint or from a capital formation standpoint. But we don't have that. It's if 90% of the trading volume in the market comes from something other than rational thought, then your pursuit of long-term buy and hold returns is going to be diminished by the odds. You have a 1 in 10 chance maybe of that working. And that's why we do this. And when we looked at the patterns of change over time, we could see institutional money come and go. And the most recurrent pattern is a 5-day pattern. That's how long it takes money of size to move. They don't have any choice. All right. So that's something we can surf as retail traders.
Tim Quast joins us every Monday as the founder and CEO of Modern IR and Market Structure Edge. I put the link up on the screen before. It is back up on the screen now. MarketStructureEdge.com to see that platform and to see market structure sentiment. Tim, always a pleasure. We'll talk to you next week.
Good to see you guys.
From a different
All
state.
right.
Thanks,
All right.
Tim.